which is better for India? Is it better if we have a recession because that will mean crude prices will be under control? Or is it better for us that there is a roaring growth and a roaring inflation outside, more or less like we had in the earlier part of the current year? What suits India better?
So let's talk to the question about between the two Hobson's choice of having a global recession versus say raging inflation, as you put it. I think that's between, being between the devil and the deep blue sea. Which one is the choice that India would prefer if I had to? So let me, at the cost of significant simplification, I think that a global recession and the way Sajid explained, which will be shallow and I think would be slightly better than a raging inflation for the following reason. I think a global recession will play out in the Indian context largely through the current account. So you have a decline in exports, increase in imports because India remains the fastest growing emerging market economy, and so larger trade balance and possibly higher current account deficit.
No, that is, you're saying a shallow recession plays to our advantage?
Yeah, so it will be current account negative, but I think it will be capital account positive. For the following reason that, if you are expecting a global recession, that means the interest rates have peaked and have started to come down. There is no flight to safety, so the rupee is not under pressure. There's a lot more macro stability, and some of the capital would start to flow back because India is doing well. So if you have so I feel a shallow global recession would be negative on current account, positive on capital account, overall good, compared to a raging inflation, which I think would be negative on capital account for exactly the opposite reason. And for the current account, it depends on where is the source of this raging inflation. If it is largely fuel and fertilizer, that's again going to be negative on current account. So overall, I feel in the situation that you are describing, it will be less harmful for India if the world economy goes through a shallow recession than a very protracted inflation for the medium term. Okay. But can I just add a preface to this story that, we talk about this as if this is like a one-time choice that India has to face. But the one thing is that 20 years ago, when a graduate student went to international finance course, we talked about something called a strong center and a weak periphery. That means there is this, the large advanced economies where the custodian of global macro stability. So there will be all this crisis in the periphery countries, but when it spreads, it will be absorbed by the core. Today it is completely reversed. The last 5 global crises have all originated in the rich countries. Whether it's dot-com, whether it's LTCM, it's global financial crisis, whether it's the cost of living index, all of them came from there. And the emerging markets are the study, and they have adopted a lot of the good practices that used to be. So in a sense, this is a part of life now. For emerging, for the central bankers in emerging market, this is something that they have to live every day and not once in a decade, which used to be the case in the past.
Soumya, let me come directly to the trade situation. This year, 6 months, we've only been discussing the rupee. And therefore, what are we likely to face if we have to be ready in 2023 on the current account and the capital account front? The October trade deficit numbers were not a pretty picture. The rate at which we have seen exports fall is scary. Imports fell, yes, from 60 billion, we came down to 56 billion, but almost entirely accounted for by the price of crude. So crude itself falling to $90 or $88 has not resolved the current account problem. It is actually keeping the current account problem pretty sticky. Will this be the run rate? I mean, 26, 27 billion trade deficit a month, and how do we get ready for that?
No, thank you, Lata. I think current account deficit is actually, the external sector of India is turning out to be a very interesting proposition. If I all recollect, I think in July, we had one seminar where we attended in the RBI, I think in Lonavala, and there the RBI forecast, I think that was below 3%, 2.8%. And at that point of time, all the entire market consensus, including we were expecting the current account deficit could actually breach 3.5%. Some estimates were close to 4%. But when the first quarter numbers were announced, and if you remember, the expectations were close to 3.6, 3.7%, the numbers came in at 2.8%. So there was actually an 80 basis point cushion and a positive surprise, even though if you remember, the first quarter was the worst hit in terms of the oil prices. After that, oil prices have started to moderate a little bit. We actually looked into this aspect very carefully, and when we did an analysis, actually in terms of some technical specification, we found out that remittances and software exports are actually acting as a very strong buffer, counter-cyclical buffer to this current account deficit deterioration because of the crude oil. And the results showed that if, for example, if suppose if the model, if the trends indicate us, and if the second quarter GDP numbers which are due on December 31st are actually close to 3.5% even, then even the full year number could be closer to 3%. So I don't know whether this will going to play out, but the second quarter service exports, as the RBI data shows, have already been very strong. Remittances have been strong, but the important point to note about remittances is that, I mean, it has been strong, but whether it remains like this, that is a matter of debate, because as rupee stabilizes, there is always a, flavor that remittances could actually stabilize. But as of now, and for every dollar rupee depreciation, the software exports actually jumped by 250 million. So that was one of the results from model. So while I agree with the fact that this amount of trade deficit is unsustainable from a pure financing perspective, but if you actually look into these remittances and software exports, which has been very strong, that has acted as a very strong buffer in the first quarter, and if the second quarter numbers are to be believed, they could still continue to act that. If that is the case, we may escape this year with a deficit which may not be as high as was earlier anticipated.
I'm not convinced of that argument. I looked at the services exports and imports, and while I'm not able to put my finger at it, it doesn't reduce the current account deficit by as much as to bring it below 3.5%. When I calculated, I still got about $120 billion in terms of current account deficit. Sajid, are you as confident as Soumya?
So our forecasts, I think, are similar to the market, where you're about 3.5, 3.6%.
So that's $120 billion.
125 billion. I think the IMF is there. But let's just analyze this on a more fundamental basis, right? The current account deficit is ultimately the investment savings gap of an economy, which is the investment saving gap of the public sector and the investment saving gap of the private sector. In other words, it's the consolidated fiscal deficit and the private sector investment saving gap. Now, in the pandemic, the deficit rose like it did all around the world, and yet the current account didn't move because the private sector offset it completely. Private savings went up because people couldn't spend, private investment came down. Now, the good news is the private sector is normalizing, and therefore almost by construction, public sector investment savings gap is spilling over to the current account. So if we want the current account deficit to come down to sustainable levels over the next 12, 24 months, which it must in this global environment, you have to have a more fundamental corrective.
Which is bring down fiscal deficit?
Which is that you need to bring the fiscal deficit down. This way you can keep the private sector humming along. You want the private sector to grow. You want private investment to pick up, savings to go down, and to get an economic recovery. And for that to coexist with a sustainable current account deficit means you need to get consistent fiscal consolidation, which I think is very much part of the plan. I'm also a votary of the belief that apart from this income effect, price effects matter, that the real effective exchange rate over time does have an impact on the current account ex oil and gold. There's a lot of research that now shows that, including some work we've done. And frankly, we focus so much on dollar rupee. The real effective exchange rate this year has been flat. And to the extent that this terms of trade shock is a persistent adverse terms of trade shock, even if oil is at 85, it's still 25% higher than the pre-pandemic level or pre-war level. Some calibrated depreciation of the real effective exchange rate is not a bad thing. And I think the RBI, to its credit in the last couple of months, has been enabling that, because that becomes your shock absorber. I keep saying it's like wearing a seat belt in a fast-moving car. That if you suddenly brake, yes, you get a bit of a shock from the seat belt, which is your exchange rate, but you prevent greater damage. I'll make one last point. I think Deepak made an excellent point about capital flows. A lot of empirical work has found that one of the most important predictors of capital flows to emerging markets is the dollar index, the DXY. And the DXY has gone up in every single US recession strongly has strengthened, barring 2008, for specific reasons. So yes, if we do get a shallower recession, you will get less strengthening of the DXY, and that will mean that the prospect of capital flows coming into emerging markets will be better. But the current account is very much an idiosyncratic thing where we'll need to focus on the investment savings balance to make that sustainable.
Thank you very much, Soumya, Deepak, Rajeshwari, Ashima and Sajid.